Investing in retirement should be different to investing when you're building wealth. I mean, the mechanics are largely the same. We use the same tools, but the weird thing is that now we're investing not to build wealth, but so that we can spend down our money in a controlled fashion over time while factoring in fluctuating markets and our changing circumstances. That's a lot to think about. Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And I did a video last week covering the simplest way for anybody to invest. I'll link to that in the description below the video because quite a bit of that is also relevant in retirement. I'm going to assume though that if you're nearing retirement, you probably know quite a bit of that stuff already. Today I'm going to cover off platforms, accounts and funds. I'm going to do that fairly quickly so that we can spend a bit more time on the retirement specific stuff, which is spending, and then a mechanism that I call the Cashflow Ladder. By the way, everything I'm covering today is available as a free downloadable PDF. Just go to meaningfulmoney.tv/retirement investing and you can download it for free. Right, let's get cracking. Look at platforms first. A platform is simply an online administration system for your investments. On a platform, you can usually hold different kinds of accounts, more on those in a sec, and also a range of underlying investments that sit inside those accounts. And when it comes to choosing a platform, there are some criteria to bear in mind, such as the architecture, whether a platform offers just its own funds, like Vanguard for example, or funds from lots of other companies like Hargreaves Lansdown or AJ Bell. The choice of available accounts is important, but most of us only need a couple of different types. The feel of a system, whether it suits you or not, that's a big factor because you're going to be running your finances on this system, so it needs not to frustrate you when you use it. And finally, the charging structure is the biggest factor of them all. Charges are applied in different ways. You get percentage fees, dealing fees, flat fees, and a lot depends on what kind of investor you are and the value of your portfolio, so choose wisely. Now, when it comes to the accounts we have our money in, most of us really only need two, a pension and an ISA. If the numbers are bigger, we might also have a general investment account or a GIA. Now with a pension, now that we're thinking about taking money out, we're going to need all the flexibility that modern pensions should provide. So we need Flexi Access Drawdown and also UFP+, that's Uncrystallized Funds Pension Lump Sum, stupid acronym. But the ability to take tax-free cash as a monthly income might be useful as well. An ISA has got no limitations or tax when you take money out, and that's going to be useful to us as we draw money to top up our income sources. So that's platforms and accounts. Next we have the good stuff inside those accounts. That's the stuff which is actually going to make us money over time, and that's the underlying investments. This can take lots of different forms, from direct shares and bonds to collective funds, which enable us to spread our money further and more cheaply than holding direct stocks. And most of us do hold funds as the core of our portfolio. That absolutely makes sense. Open-ended investment companies, or OICs, those are the main kind of fund these days, but also look out for investment trusts and exchange-traded funds. These have a slightly different architecture, and you should understand the differences. I did a video on that, which I'll link up here and in the description. Now, my view is that the vast majority of people are best served with passive multi-asset funds, and that means funds that are spread around the world and into different kinds of asset, perhaps, shares and bonds at least. And then funds which seek to track markets rather than beat them. The thinking here is that most active fund managers, whose job it is to beat the market, they fail to do so consistently. So why bother trying to find the ones that do? And spreading your money around widely mitigates some of the risk of investing with too narrow a focus. So if you've got a pension and an ISA on a platform and you're invested in a few decent passive multi-asset funds, really you've got everything you need to manage your portfolio in retirement. Now, there are two big threats to investors in retirement. Actually, there are a few more than that, but we'll stick to just these two for the purposes of this video. And the first is inflation. I'll get to the second in a minute. Most of us will have a state pension that is going to be linked to inflation and should rise every year. If we have defined benefit pensions, they too will rise each year. And we could buy an annuity to lock in a rising guaranteed income as well. Here, you hand over some or all of your pension fund or other money that you've got. You hand it over to an annuity company, and they promise to give you a guaranteed income for life or for a fixed period of time. And these are becoming more popular again as rates have risen from years of being so low that it just really wasn't worth it. If you are planning your retirement, you should definitely find out what it might cost for you to secure your baseline spending forever. And there's a government money helper page, which I'll link to in the description, where you can do those comparisons for free. But you need to know what your spending is likely to be, though. We've got to plan it. Don't wing this. Money in and money out is the bedrock of a solid financial plan. So don't just stick a wet finger in the air and hope for the best. Divide your spending into 3 categories. Required regular spending. This is the things that you need every single day. Food, fuel, utilities, council tax, basic insurance and travel costs. Next, your desired spending. These are the things that make life great. So hobbies, recreational travel, gifts to the family, great meals out, club memberships, all that good stuff. And then finally, think about ad hoc spending. These are the one-offs, like a big family holiday, the proverbial retirement camper van, changing the car to the model that you've always promised yourself. Try to think this through for the first few years, maybe even the first 10 years of retirement, and then plot the spending for each year. And I do it like this. So on this chart, each bar here is a year, with the coming year on the far left. You can see that this family are planning on buying a pretty seriously luxurious camper van in year 1. It's a big old bar, but then the spending settles down a little bit. So now we need to add in the sources of income that we know are going to come in each year. Well, this couple have got some rent coming in from a property that they own. That's the pink colour. Their state pensions are shown in dark blue, with one of them kicking in first and then the second one coming a couple of years later, so you can see the blue bars doubling in height. And then there's a defined benefit pension scheme in green, with a bigger amount in the first year because it's going to pay out some tax-free cash. Now what's left here in each year is the red, and that's the money we're going to need to draw down to meet our expenditure needs in each year. And so we got to invest with a view to beating inflation so that those costs can continue to be met. Now, I said there were 2 main risks for investors in retirement, remember? The first one is inflation, and that's why we invest in retirement and we don't just stick all our money in the bank, even with interest rates rising. But the second risk is called sequence of returns risk, or just sequencing risk. And this is the risk that market conditions might be poor exactly at the time when you need to take your money out of your portfolio. Selling distressed assets to fund your spending needs puts a bigger strain on the portfolio because those realized assets can't make back the losses. The main way we try to mitigate this risk is called the Cashflow Ladder, and its purpose is to try and ensure that we never have to sell distressed assets to have the money that we need to spend. Now, it isn't perfect, it takes a little bit of thinking through and planning, but the principles are simple enough. So I start with 4 rungs on my ladder. Years 1 to 2 at the bottom, then years 3 to 5, years 6 to 10, and then finally at the top of the ladder, we've got years 11 plus. And we need to think back to our spending plan and work out how much money we need to spend to draw off our investments in order to supplement our income in each of these years. And then we need to invest accordingly. So, the money we need in the first 2 years actually shouldn't be invested at all. This should be held in cash on deposit with the bank or building society where it's safe and accessible. You can also hold cash inside your pension and your ISA, and we'll get to that. The money we need in years 3 to 5 can be invested, but cautiously, a notch or 2 down from our standard risk tolerance profile. I call this risk minus. Money we're going to need in years 6 to 10 can be invested according to our standard risk profile, that's risk equals, and then anything we're not going to need for at least 10 years can be pushed a little bit harder, above our risk profile maybe. I call this risk plus. Now each year, this is going to need to be reviewed because each year is now a year closer. We'll have spent some of our cash and we need to think about topping up the cash buffer at the bottom of the ladder so that there's enough for the next 2 years, not just the next 1. If markets are down and our portfolio is suffering a bit, we can defer this for 6 months or a year, hoping that things will have recovered. But hopefully we'll be sitting on some profit and we can draw that from our portfolio down the ladder and drop it into the first 2 years. To determine your starting point risk profile, there are some free options online. I'll link to one of the better ones in the description. But better still, I would drop a few quid and get it done properly with a scientific methodology from a company called Finametrica. I'll put a link in the description to that as well. So we've got our money invested in passive multi-asset funds, on a platform, in a flexible pension and an ISA. We've got short-term money in the bank as well. And we've got a plan for what our spending is likely to be for the next few years, and we know how to invest the money at the different timescales according to our ladder. But what we need to look at now is what is the best place, which account from which to draw the money we need in each year. That's going to be dependent on a lot of factors, and so the next video will be another masterclass, and this time it's going to be about retirement spending, and I'll give you some examples of the Cashflow Ladder in action to illustrate how it works. So stay tuned for that, but if this has been useful, please give the video a like and subscribe to the channel if you're not already so that you don't miss the next video when it lands. Thanks for watching this one, and I'll see you next time.